Well, Dalal Street snapped its 4-week gaining streak. The Nifty and the sensex slipped 2%, which was the biggest weekly loss in the last 5 months. This was the first real signs of a correction in the market. On the Editors Roundtable this week, we'll decode what was a pretty hectic week for the market. We'll tell you why MNCs are raking in the moolah, and we'll also put the spotlight on the cement space. I'm Sonia Shenoy. With me, Nigel, Prashant, Nimesh. Also with us in the studio, we have Anish Tawakley, the Deputy CIO Equity at ICICI Prudential Mutual Fund. Anish, thank you so much for being here on the show.
Pleasure, Sonia.
This was a really tough week, right? Wednesday was the day that everyone sort of got shaken out of their slumber. And it was a real fall. It was a genuine fall, even by the end of the week as well. So, first real signs that, hey, this market is not just going to keep running up.
This is a test of character, a clear distinction between the mid cap, small cap and the large cap. So, we've been saying for a while now that it's time for the large caps to catch up. This was a week when it actually showed up, right? I mean, the kind of carnage we've seen in the broader markets, it's shaken a lot of investors for sure. Even the traders and large investors got shaken off this week in the fall.
Well, it was getting all too easy, right? You just come in there, cricketing parlance, you take a few balls, you keep smacking it out of the park. So, now you have to really look at the ball, play a shot based on the quality of the ball, etc. So, before we get to Anish, Prashant, why don't you do a quick recap?
I think you guys are absolutely right. First dose of reality. And I think even for retail, right?
Yeah.
For people who came in the last 2 years, 2.5 years, they've not seen any correction, any prolonged correction. It's been one day. There was one in March. I remember there was one late last year. So I think with this 14% drop on the small cap index from the highs, I think this was the first sense that markets don't have to compound every day.
This is the third year
they can
running.
go down as well.
In fact, this is the third year running that the March phenomenon is playing out. Ever since COVID, all the 3 years, if you look at the data of the March, we've seen this correction of 10-15 days where there is massive sell-off in the broader market. So despite the history, I think a lot of investors have not learned from it that, you need to be cautious in the March.
But, I would say, I would venture to say that even after the fall, and Anish perhaps will weigh in a little bit more here. Anish, actually, let me put this to you. So we've seen the fall, mid caps and small caps where the big fall was. You guys run flexi cap funds, etc., which allows you to buy large caps or mid caps or small caps. Were there stocks which you really wanted to buy, which you suddenly after this fall said, well, I always wanted to buy this. I always found it expensive, and now it's come to a reasonable level, so let me go all in, or not really?
Not really, because some of the even within the small cap space, right, there has been quite a bit of dispersion even in this area, right? So I don't think the really good ones have become compellingly cheap. They have come down a bit, but I don't think they're in the compellingly cheap space.
And that's an interesting point. So you're saying that what went up, you never wanted to, you did not participate on the way up because you don't find quality, whatever. It did not fit your parameters, investment parameters, and so it doesn't make a difference that they're coming down.
They're coming down.
So what you want to buy, they're still there.
Yeah. They're not compellingly cheap, and we still feel that relative to the large cap stocks, there are better opportunities in large cap.
But my question, and this is something I keep asking myself as well, is there more to go in this correction? If there is, what do you do as a retail investor? Do you continue investing? Do you buy at lower levels, or do you think that it's better to sort of raise your cash levels a bit now?
So I still think if you were to deploy funds, right, you can keep cash, but if you were to deploy funds, it would still be in the large cap space rather than the smaller cap space.
Okay, all right. And Anish, if just to get, we're talking about a correction. But on the headline index, there's no correction. It's not even 2%.
Well, the headline index is more dominated by large cap stocks.
By large caps, right.
So those hadn't run up as much anyway to start with.
So on the Nifty itself, we shouldn't see too deep a gash. Maybe in select mid and small cap names, we could see a larger correction, but with good reason as well. Because earnings in some of those stocks didn't really pick up.
Earnings, particularly cash flows, right? They weren't as strong.
Okay, all right. Prashant, let's take stock of the week first.
Just to quickly tell you, so the first dose of reality and sort of, realization that markets don't always go up, and I think I want to start with that. By the way, for the week as well, Friday to Friday, mid caps and small caps were down 5%, 4.5% and 5.5% is what we had. I would venture out and say that maybe the bulk of the big swings is behind. The big swoons, not even swings, right? 4-5% that Wednesday that Sonia was talking about. I think that perhaps is behind. But this will take time because, you would, and Nimesh was talking about HNIs and that part of the segment where perhaps people at least in certain stocks, etc., are a little underfunded. Maybe there's a little bit of leverage in the system, etc., which will get cleaned out as markets, as prices come up. There will be waves of selling which will come. And so it may be not a very long process. Nothing in the markets nowadays is very long drawn out. Corrections are swift and sharp, not like what they were a decade ago when they used to be long drawn. So this is not long-winded. This is very fast. And I think we are perhaps in the process of that. And by the way, Friday's session was good, right? Because Nifty, mid-cap, small-cap, everything was down. But the small-cap index was up 2% from the day's low. And that matters because that is where the bulk of the pain has been. It's not in the Nifty, it's not in the banks. It is in the broader universe where bulk of this participation has been. And also, I mean, now we get into the political season, right? Election dates on Saturday and campaigning and, a lot of that will dominate. For markets, does it make a big difference? Maybe not, but I think a lot of the headlines you will see in that sense will be, elections and sort of the political side of things as well. Anish, any thoughts on as we get into the election season? Any thoughts?
Look, there can always be volatility around events like elections.
Yeah.
But I would say, look, as an investor, one should focus on earnings, right? And our view on earnings is that the economy, at least from a cyclical perspective, is looking decent for the next 2 to 3 years, right? And so if you are take a 2 to 3 year view, you can debate endlessly whether the market is 5% more expensive or 5% cheap. But I think on a 2 to 3 year view, you can make decent returns in the large cap space.
In the large cap, and within large caps, is it still investments or consumption?
I would still say that it's the domestic cyclicals that offer better opportunities, right? Because if the economy recovers, it's the cyclical sectors that do well. So that's stuff like automobiles, cement, industrial and capital goods, broadly financials.
Okay, well, let's also talk about the multinational companies, right? Nimesh is focusing on them today. Nimesh, why is that?
Well, Surya, the newsmaker this week was ITC, right? We all know that BAT had sold 3.5%, but it was not only BAT which sold stake. The three big MNCs have raised close to $3 billion from Indian subsidiaries in 23. So let me just go to the wall and explain what the whole event has been for this year. If you look at this year, the biggest deal, of course, was ITC, where BAT sold 3.5% stake and they raised 17,000 crores in a single day via block window. So that was a kind of demand for the Indian paper. The second big deal was Whirlpool. In Whirlpool, the Whirlpool Corp sold 24% stake this year, and there is close to 4,000 crores. And Timken was the other MNC where the parent sold 8.4% stake in Timken India, and there is close to 2,600 crores. So these were the three large deals which happened in FY23, raising close to $3 billion. Now, look at the valuation picture, and why I'm saying this. That's been the key reason why a lot of MNCs are encashing from the Indian subsidiaries. ITC, India stock is trading at close to 25 times, all at trailing multiples. So that's at 25 times, whereas BAT is trading in single multiple at 6.5 times. And that's been the case with all the MNCs as well. The second chart, which is the next stock was Whirlpool. Look at Whirlpool's P multiple as well. Whirlpool India is trading at close to 74 times, again on 12-month trailing basis, whereas the parent is quoting again in single digit at just 9 times on trailing basis. Same is the case with Timken as well. Timken India, where the parent sold 8.5% stake, that's trading at 53 times on 12-month trailing, whereas the parent is quoting at just 12 times. So that's the kind of valuation gap which is there between India and the MNC names. I've just looked at the other 5-7 large MNCs in terms of market cap. United Breweries, Hindustan Lever, Nestle, Maruti and Siemens. Across the board, the common theme is there has been a big gap in terms of valuation between Indian company versus the parent. Look at United Breweries. The Indian subsidiary is quoting at 124 times on trailing basis, whereas Heineken is trading at just 22 times. That's been the case with the others as well. Look at the next stock, which is Nestle India. Nestle India is trading at close to 80 times on 1 year trailing basis, whereas Nestle parent is trading at just 22 times. So big gap there as well in terms of valuations. Same is the case with Hindustan Lever, quoting at 60 times in India, but the parent is quoting at just 17 times on a 12-month trailing PE. Look at the case with Siemens as well. Siemens India is trading at close to 68 times, whereas Siemens AG is just quoting at 16 times. So again, there are a big gap in terms of multiple there as well. And the last one is Maruti Suzuki. Even in case of Maruti Suzuki, the Indian arm is quoting at 32 times, and whereas Maruti Suzuki, the Maruti Corp, Suzuki Corp is sitting at close to 13 and a half times. So that's the case wherein in India, we've seen a big gap in terms of PE multiples and a lot of MNCs get a premium. I guess that's the reason why even like an Hyundai is looking for an India IPO. So clearly, from an MNC perspective, it's a good arbitrage to sell Indian company and look at, doing a buyback in the parent as well, where the valuations are quite cheap.
Nimish, just one thing. I was wondering whether growth, because are growth rates much higher here as compared to, did you sort of look at that?
There is
India as
a,
compared to...
Of course. But still, even if you look at the earnings and the growth rate, still the kind of premium that Indian companies are enjoying, it's a huge gap compared to what the globals are. And look at what is happening, right? In two of the three companies where they sold stake, it's largely been done to do a buyback in their parent company. So even parent globally feels that they're undervalued compared to the Indian arm. We heard the Whirlpool CEO saying that it's a pure arbitrage. They're bullish on India, but they find such a huge valuation gap that they looked at selling large stake and doing a buyback in the parent.
You were talking about Hyundai. I looked at the numbers. Hyundai in Korea, the parent is trading it trades at 5 times earnings.
5 times.
Wow.
What is Maruti's P ratio? So you could raise money in about, I don't know, 40, 50 times here in India, right?
Yeah.
So why not is the question.
Why not? Exactly.
Like the Whirlpool CEO was very candid, right, Mark? He said that it's a basic asset arbitrage.
Asset arbitrage, just sell and buy back my own stock.
See, the interesting thing is none of them have changed the level of control they have on the Indian subsidiary, right?
Absolutely.
So if somebody was above 50, they've come down to around 50, still above 50. If somebody was above 25, they've remained above 25, right? So nobody has changed the level of control that they exercise.
Just that it's been a good asset arbitrage for the MNCs.
Exactly.
Okay, what's your general take on the MNCs? I mean, are you bullish on a lot of the MNC stocks in India?
So, I don't really compare the domestic valuation with the parent valuation because we are not really...
on an India growth story.
See, the reason why MNCs trade at a premium, right, is for two things, right? One, they typically have stronger competitive positions. If a company is operating in multiple countries, it presumably has some strengths, right? So they have stronger moats. And secondly, capital allocation is better. See, we always compare companies on earnings, but particularly if you look at the FMCG stocks, right, their profitability is so high that if you compare them on dividend yield with other Indian companies, the gap is much lower, right? Now, so I always make the point that if you have two companies which give you the same dividend and the dividend growth will be the same, you will value them similarly, right? Just because of the fact that the PE ratio of one may be higher than the other is not really the point. So I think, look, there is reason why they trade at more expensive multiples. It's not on more expensive PE multiples.
Okay. Well, let's do one thing. Let's also talk about the cement space because the street is pricing in a weak fourth quarter for cement companies. Nigel, why is that?
Well, I was just looking at all the cement companies that are listed, and Anish, I would like your view on this as well because stocks are down between about 8 to around 25% from the 52-week highs. A few factors that are playing out. Demand, rock solid. Quarter four is normally good, and it's been very, very good. The problem is in pricing. And pricing has been relatively weak. The question is, with the stock price fall, is it already pricing in that maybe there'll be earnings cuts for the next couple of years? So maybe some part of the bad news as well is in the price. To give our viewers a few numbers, the cement demand for January as well as February, on an average, it's up between 6 to around 8%. On an average for quarter four, we'll see demand grow by close to around 8%. And larger companies, ACC, Ambuja, JK Cement, they are grabbing the market share because they're growing at a faster clip. The problem will be for the smaller players because they're losing out on market share. But pricing has been a disappointment. In quarter four, I've not seen pricing this weak. In fact, quarter four, if I compare it to quarter three, pricing is down by close to 3%. And the estimates were earlier that we'll see a more or less flattish pricing scenario, which hasn't happened. And particularly in north and east, the pricing has been very weak over there. It's down by close to around 5 to around 6% odd. And this problem of pricing has been compounded because pet coke prices were hovering around $115 per ton. That's gone up to around $125 per ton. So you have better volumes, but you have weak pricing and you have higher input costs. That's what's going to result in a compression in the EBITDA per ton. And to give you a few numbers, at the start of this quarter, people are talking about an EBITDA per ton expansion of roughly around 100, 150 rupees. Now we're working with a compression of close to around 50 rupees per ton. And Anish, the other problem is that towards the end of this year, there could be that volume push, which will put further pressure on pricing, which will put earnings at risk. The question is how much of this bad news is in the price because stocks have already been weakish. They're not seeing any big uptake. So I wanted your view, Anish. Since you're quite positive on the domestic cyclicals as well, and cement has a very important role to play. And give or take a few quarters, this consolidation in the industry is going to be very, very good in the longer term.
Yeah. So I think when I look at cement, right, and if you look at the history, it's always happened that when volume growth comes through, the pricing rationality breaks down. Right? This is not the first time it's happening. Because when there is volume growth, nobody wants to give up on volumes or lose market share for a little bit of pricing. So this is not unusual, right? Going forward, what we have, if we see the housing market, the real estate market hold up, and if we see continued investment in infrastructure, we do think volume growth should sustain. And now capacities are being added. If you look at the capacity expansion, right, about 80% of the capacity is being added by the top 4 players, which is a very big consolidation of incremental capacity at least. Also, at some stage, we'll get to a point where some of the players don't have access to limestone. So to justify in reinvestment, they would be bidding for limestone, which again, raises the reinvestment economics. So I do think like cement, as long as volume growth comes through and capacity is added by a concentrated set of players, is not a bad place to be in, although near-term returns might be impacted by
And Anish, you would stick to the larger cap names, or do you think some of these mid-caps, like I recall, just to give a couple of examples, Orient Cement, I went ahead and had met the management. From from around 100 rupees, the stock went to close to 300 rupees on various rumors also. Some of these smaller cap names, they did very well, and sometimes you get the beta over there. But would you find favor with the larger cap names itself?
No, in general, I can't comment on specific stocks.
No, just
but my point is, look, cement is actually one of those industries where it's a local industry, right? So you can look for opportunities in the smaller cap space as well, right? There are some industries where I would say there is no point going for a number 7 player, number 8 player, because he's never going to match the economics of a larger player. But cement is not one of those industries, and one can, depending on valuations at different points in time, look at locally strong players as well.
Okay, all right. Let's do one thing. Let's take a short commercial break, but don't go anywhere. Lots more coming up on the other side. A chat about what to expect as we move into the next week, and a sectoral outlook as well with Anish Tawakley. Stay tuned.
Welcome back. You're with us here on Editors Roundtable. We're in conversation with Anish Tawakley, Deputy CIO, Equity at ICICI Prudential Mutual Fund. And we were just talking about cement and what he likes in that space. But let's actually go to the source, which is real estate and construction, Anish. What's your view on that? Because that's like the super important sector with so many linkages. And that sector has been doing very well. And I think an important reason why everything else is also doing well. But where are we in that cycle?
So, Prashant, the way I see it, real estate and particularly volume of activity in real estate is really fundamental to the economic cycle, right? As long as houses are being built, one can be sure that jobs are being created in construction, and then you can also be confident that there will be consumer durables good demand, right? So, the way I see it, what I'd like to see is volume of activity. What would concern me if there was price growth without volumes. That's what went wrong in the 2003 to 8 cycle. You didn't see volume come through, you just saw price increases. At the moment, what we are seeing is both price and volume growth. So I'm still okay, right? But I would expect, what I would like to see is price growth moderating, because supply should come on. And if volume growth continues, I'd be fine with it.
Is there any way to, I mean, when real estate companies come, we say, what year of the cycle are we in? And these are long cycles, 7-8 years, right? So usually we get second year, maybe 2 years in, and so there's a long runway still.
See, if you talk about potential, right, it may not actually play out. So I don't want to say I'm confident that this will last 8 years, 10 years, or anything like that, right? But from a potential point of view, right, there is no real constraint. If we get the regulatory environment right, why a real estate construction activity cannot go on for a long period of time. In fact, if you compare India and China, I know a lot of comparisons are made about manufacturing. The real comparison should be on urbanization, right? In 1981, India is a percentage at a slightly higher level of urbanization than China.
Okay.
If you look at the position today, the total population is about the same, but they have 900 million people in urban areas, we have 900 million people in rural areas.
Wow.
Right? That's basically they built housing. When they built housing, then cement followed, because their cement consumption went from under 200 million tons to 2.3 billion tons.
Okay.
Iron and steel followed. So actually housing is fundamental, and there is a lot of room for it to run, provided we create the urban infrastructure, provided we don't let land prices shoot up too much.
Sure.
Prices have to remain low.
Okay. Another space I wanted to talk to you about was autos, because there's lots happening in the electrification of vehicles, right? The government is coming out with a lot of norms to push EVs further. Companies like Tata Motors are putting in 9,000 crores of investment in EV plants. Do you think that upcycle in the stocks is over, or is there more to go?
So I think, look, I don't think EV necessarily means that the incumbents lose out, right? Because as you said, the EVs are going to be one of the options that the consumer has. There is a fair amount of uncertainty about how much EV this thing will happen. But I think as long as the company has reasonable sort of, bets placed in that space and is developing the technology and the products, it's ultimately volume growth that will matter, not so much the EV versus non-EV.
But do you still like the stocks?
Yeah, we like that.
Okay, all right. Anish, we'll leave it at that. Thank you so much for joining us. And
I hope you come more often
my
on the
pleasure.
program. Lovely to have you.
Thank you.
Well, thanks a lot. With that, it's a wrap on this edition of Editors Roundtable. Have a great weekend.